Junk bonds flashing warning signals. Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Tavi Costa, macro strategist at Crescat Capital. Hi, Tavi. It's great to have you on.
Thanks for having me, Maggie, and looking forward to this.
Yeah, and I appreciate you taking time because, wow, it has been a super hectic market. And for all of you, you should know Tavi, being the hardworking guy he is, was slamming the keyboards right up until we hit the go button because it's that kind of market. I mean, you can't take your eyes off it. There's a lot to go through. So very ugly. And if you are driving or commuting or listening to this, very ugly end to the US session here for equities. We saw the NASDAQ down over 2.5%, S&P down over 2%, Dow as well, just right across the screen, and that selling intense right up through the close, no reprieve. We have investors jittery over tariffs or the uncertainty around tariffs. We had a key inflation gauge come in a little hotter than expected. But this also seems like part of a bigger picture. We had the 10-year yield backing off a little bit, even though that inflation number came in higher. I know you've been watching the bond market, Tavi. When you look at the action you're seeing, what story or signal are you getting from the bond market? What is the action telling you?
I'm watching closely because I think it's one of the most underappreciated risks, and it has been the case for a while. But recently, we've had if you look at junk bonds specifically, they were below 3% spread versus the Treasury yields, and that caught my attention because the only time we've seen this staying at below 3% as long as we saw recently was back in July of 2007. And that immediately sort of, was the beginning of the global financial crisis and so forth, of which I'm not saying there are major links to the two environments that we have currently. However, usually you don't see that type of risk being completely priced out of the market for too long. Risk stays in the market for a certain amount of time. And right now, I would say, the level of complacency measured by the fact that you have junk bonds spreads being so tight relative to Treasury markets, to me is a sign of that things could actually, we may see a volatility event brewing. And so it is interesting as well that you've had this big sell-off in equity markets today, and we've been having a sell-off, and it's been mostly driven by things that have done very well in the last 2 years. So Mag 7 are already in a bear market, not a correction, a bear market. They're down over 20%. And at the same time, you look at consumer discretionary, which is a pretty significant size of the economy when it comes to relevance of a sector. So those two things are leading the market on the downside. And you have 2-year yields beginning to fall, of which I think it's a major opportunity. That's just my 2 cents. In the sense of how I think 2-year yields could easily be cut in half in 12 months from now. And I could be wrong. It could be 100 basis points, and would still be would still be a hell of a trade if that's correct. And so I just think there's deterioration starting to show in the credit markets, and the difference between the sell-off and the prior ones is that, one, you're seeing the things that have done very well given up. And second, you're finally seeing credit spreads behave like there is a potential for a volatility event. So, yeah, I think it's a bit different than the sell-offs we've had over the last 2 to 3 years. And it could be a bigger correction than a lot of people are expecting, in my opinion.
I think that's really important what you just said, and really worrying. I just want to underscore it because I feel like people have been looking at the pain in the tech trade because so many of us are exposed to it, and sort of feeling like this bad news is happening. The way you put it, it's like this is just the appetizer course. I mean, things could get a lot worse, and the pain could be a lot more spread out, not just the Mag 7, if this plays out the way that you are concerned. What's the source of that volatility event, or the continued bearishness? What triggers it? What's wrong, or what is the risk that investors are so complacent about?
Well, it's a few things. I mean, it's this rebalancing out of the Mag 7, the rebalancing out of technology and consumer discretionary in this highly concentrated market internationally and domestically. So internationally, because everybody just been flocking into the U.S. And at the same time, if you go inside of the U.S., everybody has been flocking into tech and the big names. So the rebalancing out of those things, it's historically this usually tends to be more turbulent than I think a lot of people are given credit to. And so I think that's really the source of the volatility would be out of those names selling off. But there's maybe a bigger story behind this. First, inflation has been extremely stubborn. And I would say that what I think a lot of people are dismissing, especially from the last Fed press conference, is the fact that I'm not sure the Fed is really coming into a rescue anytime soon. So, I think the Fed is extremely political. There are reasons to believe that inflation is not out of the system. And there's also reasons to believe that government data, of which we all can argue it's irrelevant from if you're in the mainstream and actually living your life and going to the grocery stores and seeing prices of things going up, quite significantly, never falling. But if you look at the government data specifically, and you just do a completely unbiased calculation of where inflation is, again, CPI, core PCE, Michigan University, all the things that the Fed tends to look at, super core, and you calculate that on the Taylor rule model, you're going to see that the Taylor rule model is not suggesting you should be hiking rates. But wait a minute, the market has 2 to 3 cuts priced in for the end of the year, and the Taylor rule is telling you have to raise rates. You have a Trump presidency, essentially pressuring the Fed to lower rates at almost all costs. Lower rates right now, you're making a big mistake. I mean, Trump literally tweeted something along those lines last week. And the Fed has everything they want to justify saying, no, we're just going to wait and see. And I think they're going to take that card all day long. And first, if you see, how many times are we listening to Scott Besson on TV literally every day? He speaks for 30 minutes. It's screwing up my schedule because we all have to listen to him because he's extremely relevant. But he's trying to, this is on my opinion, other people have said this very eloquently, that he's been trying to basically take away this relevance of the Fed and by speaking more often and actually sort of hiding a much bigger message than the Fed has been trying to accomplish. And the Fed has this opportunity, if you're losing relevance, to become relevant again by just saying, yep, we're not cutting rates, and so what I think it could happen in that environment, and this is very much against the consensus in my 2 cents, is that if you actually have the Fed doing this, I think the 2-year yield would fall drastically because a lot of people in the market would start pricing in recession 2 years from now. And so, of which rates should not be at 4%, I'll tell you that. I mean, I think Druckenmiller is probably licking his lips right now, just looking at the chart of the 2-year yield and saying, wow, what an opportunity for me. I made all my money in my career basically trading the 2-year yield at times of turmoil. And here we are now at 4% with the major rebalancing happening, and everyone is saying that, no, because of inflation, 2-year yield is going to be higher. I don't think so. I actually think if you get a 30% plus, let's say big decline in the markets, yeah, then the Fed will cut rates for sure. But not now. There's no damage in the economy yet to justify cutting rates. So the Fed is going to take the role of saying inflation is still, in the system. We're going to have to wait and see. And that would be enough for, the 2-year to completely, fall apart, in my view, and invert basically relative to the 3-month yield in a big way.
So because they hold off and they wait too long, basically. That's what the 2 years telling you, that they're holding tight and they're waiting too long. So I'm glad you just mentioned the economy, because it is so much more complicated now because you have the political situation feeding into this. We know that the administration wants lower rates, in addition to a lot of other things, which we'll get to in a second. Do you think the economy right now is on track for recession?
Well, I think it's very policy driven. Um, and I don't think anybody can really say that with certainty. I don't think it's below 50% either. I think it's higher than 50%.
Mm.
And if you are of the view that it's above that 50% level, then some things, not everything, are mispriced. Then you shouldn't have credit spreads at 3%. That should have a six handle, seven handle. And you shouldn't have a 2-year yield at 4. That should have a 2% handle. So you start putting probabilistically where some assets are versus where things could be, if assuming such a high percentage or probability of a downturn in the economy. Yeah, I think a lot of things are mispriced. I also find it interesting, this behavior that we're noticing with especially the dollar. Markets falling quite strongly today. At the same time, the dollar falls in tandem with the market. And these are, pretty significant. I mean, I've been very vocally saying that I think the dollar will be entering a bear market versus other fiat currencies. Yes, I've said this about gold, silver, and all sorts of things. And I have not changed my view on those, but I'm adding to that opinion on the fact that I don't understand how the Trump administration will accomplish what I think it's their biggest goal. It's reducing interest payments to GDP, but it's also reducing what I view as what they said. It's almost like a chronic deficit in the current account, not even fiscal, the current account. And so in order to fix that, you don't have a strong dollar. You can't have a strong dollar. You have to weaken your currency. And I looked at historically, and the dollar is today at its most overvalued level in possibly 120 years.
Mm.
The other two times we've seen this was 1985 with Plaza Accord, coordinated act to devalue the dollar, or 1933, which was after the Great Depression, and the US decided to devalue the dollar. So, and this was not a coordinated act. I mean, other central banks possibly did not want that to happen. And, it was sort of a period where you have a very stagnant growth period because of the Great Depression. And that was basically what got us out of it at the end of it. So all I'm saying is, yeah, this is very different politically and economically speaking, but the dollar cannot be this strong. I don't think you can't restore global growth with the dollar where it is, and so you get into a place where now you're thinking, all right, well, then you're going to get yields need to fall. So you have a view on 2-year yields. I do, at least. And then you have a view on the dollar that needs to fall as well. It would make sense that this rebalancing out of US into other countries like emerging markets would make a ton of sense. And it is making sense more and more, because what are the things you worry about investing in emerging markets? Well, you don't want a strong dollar, and you definitely don't want a rising yield environment in the US, because that's competition. Why would anybody invest in emerging markets if you can get 4% in dollar terms in the treasury market? That's pretty high. But if you're of the view that that's going to fall into half, or whatever that is your view, that is certainly mine, then emerging markets are going to get more attractive again. Not just emerging markets, developed economies and outside of the US. And so, yeah, I just think that there is a big rebalancing happening, and globally and domestically. And yeah, and then there's a lot of things to be doing right now because of all this.
Yeah, we have a couple questions coming in. Hey, everybody in the chat. Happy Friday. And hi, everybody on Substack watching. We made it. It was a long week. It feels like every day is a week, but there are a lot of people, when there's this kind of volatility, like you said, though, Tavi, there are things to be done, and there are always opportunities in that. So I'm glad that you sort of brought that up. So let's get to a couple of these questions. They're sort of related to what you were just talking about. J&J asking, does Tavi have a view on Brazil and industrial miners as a sector? And looking at some specific names, Vale or PBR as single names. I know you watch Brazil, and I was excited to talk to you, Tavi, because I feel like we've talked about it in the past where you have been seeing opportunity for a long time. But now it seems like it's really in vogue when people are thinking about this finally being a moment for international and emerging markets to shine.
Yeah, well, Maggie, I'm maybe very good at being early in things sometimes, and a lot of people think being early is being wrong. I think it depends because being early, if you're not losing money necessarily, and you just massively improving your network in that area of expertise that you're looking to grow, and at the same time improving your knowledge about that market, and when the timing is right, like for instance, the amount of people that come to me now and ask me about mining stocks and gold and all that, and the questions are just so basic questions, right? I mean, that's because people have not spent years, looking at these things. And by no means I think I am an expert, but I appreciate having that, learn, that lesson a few years ago, of going deep into this industry, and now being in a position where, yeah, I sort of, have much stronger views on where to deploy capital here. Same thing I believe in emerging markets. Look, I've been started to change my view maybe a year or so ago. So, for those that like to track my performance, there it is. And I didn't know if it was going to be Brazil or others. I had a very strong view about South America specifically. So we bought a large miner in Bolivia, of all places. Some people don't even know anything about Bolivia. And then I got deeper into this. I decided to start really investing more in the bigger names in Brazil. You look at the banks are extremely cheap. If you just do a valuation historically of the largest banks in Brazil, which have been in business for over 30 years. Mm-hmm. They're one of the cheapest, they've been historically, not only relative to their own history, but also versus other banks in elsewhere. And the names that this, I think was a gentleman, said mm-hmm. about PBR and Vale, those two are, are state-owned companies. They've got they're much bigger businesses than I usually invest. I would suspect that if the flows come back to emerging markets, companies like that will benefit. They're very linked to, obviously, commodities, and so is the entire economy. Then later on in my sort of stage of learning, I'm learning just as much as anybody else and any investor. I've done more research on this, and how do I feel very exposed and positioned on the mining industry and the gold and metals and all this. I feel naked on emerging markets, to be honest. And so I was really digging in deeper. It's just the last 6 months, given my changing views on the dollar. And I was like, well, this is not good. I mean, I don't want to be holding a bunch of, a lot of my net worth is in dollars. And I was, all right, well, how do I change that accordingly? And so I thought about real estate. And so we bought real estate in Brazil recently. It's down 55% in dollar terms from its peak levels. And I just think that, if you're in a period of generation of wealth in those areas, ultimately that spills over, the real estate market, especially the luxury market. And so, I think there's a lot of opportunities in that market. I think we're just getting started. And, you can invest in even government bonds. They're providing you, depending on the duration, you can get 17, almost 20% yield on that. And you're not on the dollar. I mean, I don't know. I think there's some big reasons to be looking at diversifying away from your dollar-based assets. Doesn't mean you should do completely, but if you're over 50% of your assets in the US, yeah, I think you should consider it. I definitely have drastically changed mine. I'm happy with it, and I kind of wish I had more. And so Yeah, I think there are moments to invest in those areas, and I think we're entering another one.
Do you are there risks for individuals? You're obviously highly skilled. You do deep dives, you buy companies. Are there risks for individuals if they're looking at those hard assets? Is it a little tougher
Uh,
to access that if you're on your own?
It's extremely hard, and actually, it's a good lesson to why Brazil is an emerging market. Opening a bank account, sending money there. Oh my gosh, it just opens your eyes about why the U.S. is where it is. And but this is not Brazil, right? I mean, it's specifically the case with any emerging markets. A lot of European markets too. I was talking to another other real estate folks in Europe, and suffered similar issues as well. The US is a lot easier to maneuver and send money back and forth and all these things. Of course, you got to show that you're not a fraud or anything along those lines, but it's very difficult to send money to those countries. Maybe a reason why they're so cheap. But listen, back in the early 2000s, Brazil was not a very open economy either, and still had its own cycle. So I do think structurally it needs a lot of changes. Like that made me think about how structurally Brazil is so there's so many problems, right, in attracting capital. You only learn these things when you get your hands dirty. We can all say things about Brazilian equities and all these things, buy this ETF, buy that. But when you get your hands dirty and you're there in the ground, no, I'm Brazilian. I go there every year. My goal is to live there, maybe 5 to 6 months of the year there at some point. So, and why? Because I can see a 10-year cycle here. And so I kind of want to be in the forefront of this. And so, yeah, I think there's a lot of risk. No doubt about this. And there's risk on the corruption side. I usually joke, but it's true. Every once in 3 years, I guess, every once in a while, you have a volatility event that happens in emerging markets. Usually, somebody got arrested, or a new person, somebody killed somebody, or something crazy happens, right? Or there's a corruption scandal that you learned that nobody knew about it, and then the market has those shocks, and that's it. I mean, it is what it is. So don't go crazy. I mean, that's you're gonna have. All I'm saying is you're going to have windows of opportunities to come back and come back and come back, and it's okay. It's just
Yeah.
it's how the market works. But
And
there's
and
risk.
and increasing your allocation slightly is different than going all in, I think is what you're saying as well. And so there are risks. You're getting compensated for them, but there are still risks. As we always say, these are broad discussions. We're not giving anyone financial advice. You have to know where you are on the risk profile. But these are the things we're going to have to consider after really just sticking it in the US. I mean, everybody was just stuffing the NASDAQ for the last. So this is a new set of muscles that we're going to have to build. We got a question, and it might have been let's just circle back to something we talked about at the very start. Eccentric is asking, can you tell me what you see in junk bonds, because it's not dropping fast enough? So you're worried about an event, but like, how do you see this playing out, and what's the fallout? I mean, do we see rising defaults? What happens?
Full disclosure, we are short junk bonds, and the
Thank
reason
you
I'm
for saying that.
saying this, yeah, and the reason I'm saying this as well is because partially there are some, I think there's some issues regarding how. Well, look, if you look at even lower ratings like leverage loans, for instance, I think there is an ETF, BKLN, that is a great way to measure performance and even lower credit rating market. And you can see that the performance of that has been dismal. And not only that, it's been breaking down and potentially leading junk bonds. And so the reason why I'm worried is, I think I'm not in the market to report what happened. I'm in the market to think about what could happen in the future. So what this person said is right. I mean, it hasn't happened yet, but I'm paying attention because I'm seeing all these things that usually are linked to junk bonds that have already disconnected and are down substantially relative to junk bonds. And I feel like junk bonds is just rolling over, and everyone's like, well, I'm going to wait and see. I'm like, no, I want to I want to pay and see. And so I'm in front of it, and I just want to look. It's one idea. No one is betting their career on this, but I think that if you're of the belief that the market could fall, and I'm talking broadly, let's just say you're going to get to a actual bear market, so down over 20% in the market, then spreads are not going to be where they are. Most likely they're going to go a lot higher. I think that's very possible, because the last times we had situations like this where the market was down 20%, what happened with the Fed? Came in and said, "Hey, here it is. This is new way of providing additional liquidity to the market, regardless if it was the banking situation with SVB, or or the repo market, or the TGA account. I mean, there's so many different things that added liquidity back to the market. But wait a second, now the Fed is in a different regime. The Fed does not want to help necessarily this administration. And I do think the Fed is political. I would not understate that. I mean, this is a very important point. There has been many signs of actual Fed members writing OPADs against Trump in the past.
So they're not gonna cut rates, and they're not gonna help or lend liquidity because they don't want to help Trump. Or let me put this in maybe a less political way. They want to show they're independent.
I do think that that's the case. And the only way to show their independence is very similar to what we saw back in 2018. I mean, I remember that very well, because it was a big year for us. And there was a lot of talks about Trump pressuring Jay Powell to lower rates. And he was very stubborn. And he only changed his tune once the market was down over 20%. And so all I'm saying is, I do think, and by the way, at that time, the 2-year yield was also cut, I'm not sure in half, but quite significantly. And so this is one of those moments that you want to, the term would be T-bills and chill, but I don't think 2-year yield is considered a T-bill.
Yeah,
So,
and so I want to ask you two things while we still have time. First of all, I know you've been bullish gold. Again, you were out talking about this. We've been talking about it together for a couple of years now. You kind of recognizing that you thought that's where the opportunity was. It is moving now, right? So we are talking in the present, not that I think this is going to happen. Is there still a lot of room to run? Because I think some people are going to look at it and say, well, I wasn't in it. Is the move over now? Where are we in the scope of gold's move?
I think from a trading standpoint, it could be a bit stretched, but from an investment standpoint, if your goal is to buy and close your eyes for the next 5 to 10 years, it's extremely cheap, I think. So I think gold, we are in a place where the US is finally not realizing I'm not saying anything new. I mean, gold bugs have pound, and I'm not a gold bug. They have pounded the table on so many things, and those things have been completely irrelevant. Now, there is a moment in history where, and if you have used any of their data points for anything in terms of investing outside of gold, you would have lost all of your money. But there are moments in history where these things matter. What things am I referring to? Is your reserves of gold versus your treasury or government debt outstanding, or your money supply, especially when you have situations where you're starting to become challenged by other major economies for a push towards a multipolar world. That's certainly what we're seeing. And on top of it, if you looked at the central banks internationally, excluding the Fed, excluding the US government, they have been accumulating gold like there's no tomorrow. In fact, what's been officially reported, these institutions are holding today what is equivalent to their 50-year highs, while the US economy is holding what is equivalent to its 90-year low. Okay, so there's a big divergence between these two. And we now have a new administration. The people in charge, and I'm going to refer to Scott Bessent, Steve Moran, all these guys. Scott Bessent specifically, largest position was gold. knows very well the value of gold, knows well why is, I don't even need to say it. He knows more than anybody here. And I think he understands that. Now, there's been a lot of conversations and a lot of noise. In my view, it's noise regarding strategic reserves on Bitcoin and crypto and all that. Let's be open and honest to what's going on. If you're the US economy and you need inevitably to buy gold in order to fix some of your disciplinary issues, given the fact of how much debt you have and the challenging environment you're now receiving from the dollar, and you're forced to buy gold, do you announce to the world that you're going to do it and then you do it? Or do you do it and then you announce to the world? I think it's a pretty obvious answer. And so when I see these numbers out of, I don't want to speculate, but when I see numbers out of Switzerland, US importing a ton of gold and nobody knows where it's coming from, I have to say that is just really interesting things going on. It would shock me if by the end of this administration, we don't learn that the US has been participating on accumulating gold as well. I will really say this, they cannot say this to the world. I mean, this is something they have to do it, and hiddenly, because otherwise the dollar will crash. I mean, you literally cannot do that. But it is absolutely critical that they do that. And I think this whole idea of revaluing gold was very relevant as well. But unfortunately, maybe the conclusion was, do we have enough gold to revalue? I mean, we need to buy it first and then, I actually think, there's some really important things going on in that front. And
That's
then
such a great point. That's such a great point to make, Tavi. And thank you for sort of reminding everybody. This is why there was so much confidence when Scott Bessent was announced as Treasury Secretary, but he does know his way around the markets. Like, this guy knows the intricacies of financial markets. So very interesting to put that together, that he might do something like that. Maybe that's why they talk so much about the Bitcoin strategic reserve as a kind of a, look over here, instead of what they were doing. So that's a fascinating concept that you raised. One more question before we go, because I think this is really important to your thesis, the dollar. Do you see, a lot of people agree that the dollar's too strong? I mean, it would help a lot of countries if there was some normalization of the rate of the dollar, that whole dollar milkshake theory, that it's kind of crushing a lot of countries around the world. Do you see this as a negotiated, orderly dollar devaluation? Or do you see this as something that is disorderly and or unilateral?
I don't think it would be disordered, but I don't know if it's organic or coordinated. I think that's the question I don't have an answer for. And the reason for it is because if you pursue austerity with a loose monetary policy, again, I don't think the Fed will cut rates now, but the market falls and ultimately the Fed will. The Fed will do that. And well, we're talking about 2-year yields maybe be cut in half. That's a very loose interest rate policy, if I should say. And if you have the combination of those two, Druckenmiller talked about this many times, that if you have that combination, is usually the death of a currency. And so it doesn't mean we're going to lose the reserve status and all, but that's the organic combination to force the market to devalue the dollar. And so I think we're in that position. I also think that another point to be aware of is something I've highlighted a few times already, which is interest payments to GDP, that a lot of people know about this. What they don't talk about is when you looked at the US versus other places in the world. I mean, nobody but Brent Johnson from the milkshake theory, which I'm good friends with, will always tell you one thing, which is absolutely true. The dollar is a relative game. And he's right about that. And I've been in his camp for a long time too, and he knows it. I've changed my tune in the last 6-7 months, and I was wrong initially. And I think we're at the beginning of seeing much bigger movement on the dollar now. What I think it's happening though is that from a relative basis on interest rates, the U.S. is paying 5% of GDP to service the debt. Most of the large economies in the rest of the world, including Japan, are paying less than 1% or 1% or maybe 2% at its highest. Oops, sorry, one sec. My computer locked. One sec. Back. And so I think there's a greater sense of urgency for the U.S. to lower rates relative to the other places in the world, given that situation. And as we see the rates falling in the U.S. relative to other countries, as a push towards reducing this burden on that, I would suspect that that's going to have a big impact on the currency side. So yeah, that's my 2 cents. And then the last part is just final is a coordinated act. I mean, we've heard about the Mar-a-Lago Accords, and now are saying it's not going to happen. Now it's not. We don't know, right? But what we do know is that there's a push in the administration towards restructuring the U.S. debt with other countries. And that we've seen in history this a few times. And that just means lowering their rates as well relative to other countries. And so, yeah, that's all negative for the dollar at the end of the day. And so I think you need to put that view for the next 3 to 5 years and think, what are things that benefit from a falling dollar relative to other currencies, not only with hard assets, but other currencies as well.
Yeah, absolutely. Big changes coming. By the way, we're going to talk a lot about that hard asset story, the dollar, and what he calls a dishonest default. I caught up with Rick Rule, and we'll release that for you guys on Sunday. He's going to echo a lot of what Tavi was just talking about and put his own Rick Roll spin on it, as you know, which is always entertaining. So it was a great conversation. He had a little extra kick in his step, as you can imagine, based on what's happening with gold. Tavi, it was so great to catch up with you. Thank you so much. And you have been doing deep work in this area for a while. And it's really a great time for you. So we're going to put a link for everyone to go check out everything Tavi's up to in Crescat in the description, so you can go find more of his work there. Tavi, thank you so much.
Thank you very much, Maggie. Yeah.
Thanks, everybody. Great chat, great questions. Have a great weekend. Rest up. It's going to be another crazy week next week, but we'll be here for you. Take care, everybody.
Take care. Bye.